and welcome to this Christmas special on Moneycontrol. I'm Mahalakshmi and I have with me from Kotak Institutional Equities, Sanjeev Prasad. Thank you, Sanjeev, for joining me on this discussion today. You know, yesterday morning somebody was telling me that J.R. Verma is really the lead indicator in the MPC, and I say Sanjeev Prasad is the lead indicator from the sell side. And you're usually very good at smelling something bad if it does, much ahead of others. And I saw your report yesterday that you think next year first half is going to be just as good as or bad as this year. What makes you think so?
When you look at the starting points, you have valuations which are fairly expensive to start with for most of the growth stocks. If you look at the multiples for the broader market, let's say Nifty 50 index is trading at almost 20 times 12-month forward basis. So the starting setup is not that great. And more importantly, if you look at the individual stocks, most of the stocks, when I talk about stocks, I'm talking more about the growth stocks. In, let's say, the automobiles, consumer staples, consumer discretionary sectors, IT, etc. Most of them are trading at significantly higher multiples compared to the pre-COVID levels. For example, if you compare March 19 multiples with current multiples, most of the stocks are at least 5 to 10 P in terms of 6 times higher than what they were in March 19. And if you look at the interest rates, they are more or less at similar levels. 10-year G-Sec yield in March 2019 was about 7.35%. We are currently at the same levels. So despite whatever we are seeing globally in terms of interest rates rising and compression multiples, India doesn't seem to have gone through any of that correction multiples. So we have seen interest rates in India also moving up. We are back to, let's say, March 19 levels, but multiples are significantly higher. The other thing could be the market is betting on significant improvement in growth going forward, which I'm not very clear, because if you look at the last few weeks, the commentary from many of the companies has been actually quite downbeat, and this is pretty much across the board. If you look at apparel, consumer discretionary, automobiles, QSR, pretty much every company is suddenly starting to talk about significant downshift in demand. I'm not very clear about the factors, but it could just be some amount of slowdown in hiring in the organized sector, particularly the IT services space. It's possible that high inflation is starting to affect discretionary demand somewhere. And lastly, we've also seen fairly stiff increase in interest rates as far as the mortgage rates are concerned, and which will definitely impact the EMIs of the households. Whoever has a mortgage loan, as an example. And all that probably put together resulting in some amount of slowdown in consumption. So I'm not very clear, what is the market really excited about. Multiples are very high, clearly ignoring the macroeconomic setup, which is pointing towards much higher interest rates, in the sense, interest rates will stay higher for longer. And clearly some amount of slowdown in discretionary demand.
Sure, that's a lot of stuff bundled into one. So Sanjeev, I have a point here. There is a slight contradiction since you started off this conversation with valuation. A contradiction in the sense that, in the last 2-3 years, especially post-pandemic, we've believed, because of the large amount of foreign inflows, notwithstanding just last year, that India has become a asset class on its own, and we are, therefore, the flows have come in, and people, foreign investors particularly, have a higher, the perception is that we will be on a higher growth trajectory from here on, banks are clean and so on. So if that narrative were to be true, it has to be accompanied with higher valuations, slightly better than what we got in the past. But we still continue to, look at past averages and say that valuations are higher. How do you corroborate these two things?
Well, if you look at growth to start with, first of all, we have to wait and see whether that growth comes through or not. So far, we are not seeing any signs. Let's look at various sectors. So if you look at two-wheeler sector, for example, volumes numbers are significantly lower than what they used to be, let's say, 2018 or 19. If you look at four-wheelers, we are just about getting back to FY 2019 levels. Yeah. So clearly, we haven't seen any meaningful acceleration in volumes to start with. And the second point to keep in mind is the fact that most Indian companies sit on very high levels of profitability. And one of the concerns I have is across sectors, you're starting to see, in a way, a breakdown of oligopolies or monopolies, call them whatever, which will definitely impact the pricing power, realizations, profitability of companies going forward. So as of now, growth is still a question mark. I remain hopeful, but so far the evidence is on the contrary. If you look at let's say the 3-year CAGR for volumes across sectors, it's been pretty disappointing actually. Barring some amount of discretionary consumption, which has done well on a 3-year CAGR period, I'm using 3-year CAGR primarily to account for the COVID period. So we compare current versus pre-COVID period. It's not as if volume numbers accelerated. On the contrary, volumes, CAGR is actually very disappointing. So unless until we see a big rebound in volumes going forward, I'm hard pressed to make a case for higher multiples compared to whatever we have seen in the past. Also keep in mind the fact that last 10, 12 years, ever since the global financial crisis, you have had a period of abnormally low interest rates globally.
Yeah.
In fact, as far as the global markets are concerned, or the larger economies are concerned, you have pretty much zero nominal interest rates or very negative real interest rates. So all that has resulted in meaningful rating in multiples. I don't think we are going back to that era. If anything, we are looking at a situation where real interest rates could be modestly positive. Central banks would now be a lot more cagey about inflation. Any signs of incipient inflation, they're going to act a lot faster, a lot harder in trying to control inflation. So all that would suggest to me that you are looking at big shift as far as the interest rate environment is concerned, which was one of the big supporters of valuation in the last 10, 15 years. So you are headed into a period of higher interest rates, which means higher cost of capital to start with. So to argue for higher multiples, when growth is simply not accelerating, I think it's a bit doubtful at this point in time.
So Sanjeev, you're talking about consumption slowdown, right? So now is that demand slowdown you are seeing for the next 2-3 quarters, or do you have concerns over consumption growth, over a long period of time, let's say 3 to 5 years?
I think hopefully 3 to 5 years things will be a lot better. But Mahalakshmi, before that, what we need to see is a big step up in investment. And fortunately, we are not seeing that so far. Obviously, the government done a lot of good things in the last 3-4 years in terms of rationalization of the taxation regime, some amount of change in labor laws, even though they have not been notified as yet. Ease of doing business, all that issues have been addressed. And of course, you have the PLI scheme, which will hopefully result in more investment going forward. So all the good things seem to be there. You're also starting to see some pickup as far as household investment is concerned. The industry demand seems really okay as of now. But if I look at everything put together, it doesn't look like we are seeing a big acceleration in the investment cycle as yet. Hopefully, with next year or so, as some of the PLI scheme-led investments actually start hitting the ground, hopefully you'll start seeing some acceleration investment going forward. But that can put India into a much more sustained cycle of investment and consumption and so on and so forth. So as of now, the missing piece still seems to be investment. It's happening, but not at the required rate, I would say.
Fair enough. So how do you explain this credit growth of 18% upwards? Because that's a little perplexing. If you have 18% credit growth, of course, last quarter we could have argued that, because of the working capital requirements, credit growth was perhaps buoyant. But if it continues at 18%, I mean, where do you see that money really going? If it's not going to power capex, is it early indication of stress in the system? Is it because more stressed companies are getting more levered? What is it?
No, as of now, at least the YOY growth has been driven by growth more towards the retail consumer, as also NBFCs. NBFCs in turn will mostly lend to the retail segment. So most of the incremental demand for credit is largely been driven by the retail sector, not so much as by the industrial sector. I mean, if you look at industry also, we are seeing some recovery over there. At least power and road seem to be doing okay. Steel, obviously, you're seeing some number decline, but that is understandable because you have 2 years of very high cash flows free cash flow that is for the steel sector, which resulted in deleveraging as far as the steel sector is concerned. Yeah, having said that, don't just go by the yearly numbers because you had a low base or to start with. If you look at 3 years CAGR, once again, for credit growth, it is not that impressive, by the way. It is still sub 10%, yeah. So, year on year, everything will look good in India because you have the first phase across, sectors. And also higher inflation does also result, the growth numbers start to look a little bit more exciting than what it is on a more fundamental basis.
And what is your expectation on public investment spending, and what is the number that will satisfy you in this budget?
The real problem is, government simply does not have the capacity to spend. If you're running, 9.5% consolidated fiscal deficit between central and state government, where is the capacity to spend? A lot of the government's revenues are actually eaten up by interest payments, salaries, wages, pension allowances. There's also subsidies. So the ability to spend is quite constrained. If you look at public sector investment as a percentage of GDP, that is hovered around 7.5% for the last several years now. So no real change over there in the sense it's moving in line with nominal GDP growth. If it has to grow further, then clearly something has to give over here. I don't think India can have a model where the bulk of infrastructure is being funded by very high fiscal deficits. Eventually, India will have to go for fiscal consolidation. And unfortunately, given the fixed nature of a significant portion of the expenditure, the cut will unfortunately come on capital expenditure. So, there are 2-3 ways to ultimately fix this problem. One is if growth picks up, automatically revenues pick up because of tax buoyancy reasons and so on and so forth. Then maybe the ability of the government to finance incremental capital expenditure, particularly in the infrastructure sector, is still okay. The other option is to try and see how quickly you can get private sector to invest in real infrastructure, which is in the areas of, let's say, electricity, mobility, and water. Because as of now, most of the investment in these areas is largely done by the government sector, not really by the private sector, barring electricity generation or long-distance highways. I mean, everything else is largely in the hands of the government. And unless the government's fiscal position is not better, I'm not too sure how we can fix this problem of accelerated investment in infrastructure.
Right. So what would be your assumption for public spending next year from the government?
I assume, you take some high single-digit growth rate, not very different from whatever we have seen in terms of in line with nominal GDP growth, I would assume. The risk over here is, the government has also extended now the free food for all subsidy scheme all the way till December 2023, which means automatically you're starting with, much higher expenditure compared to whatever the market was assuming earlier. So again, the ability to spend on, capital expenditure gets constrained in that sense, And Mahalakshmi, one of the fundamental problems is none of the government entities actually generate any real surplus. So ultimately, they all have to depend on government budget only for financing any sort of capital expenditure.
Correct.
If you look at the case of railways as an example, the railway budget has increased significantly as far as capital expenditure is concerned. But internal accruals hardly account for, I think, if I remember correctly, less than 3% of total capital expenditure of the Indian Railways, which means it has to depend on government budget or external borrowing. I mean, where are the internal resources? That's the bigger issue as far as funding capital expenditure is concerned. So somewhere we need to see, a big change in the policy and pricing framework of the government of India, which allows for much higher private sector participation and, pricing overhaul so that, it can be profitable investment for whosoever, whether it is the government entity or a private sector. It has to be ultimately profitable for it to become a lot more self-sustaining.
Sure. So would you say that the government's ability to spend next year, especially perk up public spending next year itself, could be a risk to growth? For example, like you said, railways is not producing surplus. Similarly, even in roads, you see, a higher level of leverage in NHAI, and their ability may be curtailed next year to spend. Would you agree?
1 or 2 years we can manage. I assume you will see a fairly high number for fiscal deficit for the next year also. I mean, we're looking at some fiscal consolidation earlier, but it doesn't look like that's going to be the case because the free food for all scheme has been now extended to December 2023. So he will still run fairly high fiscal deficit. which means in a way the government is spending on growth in some shape and form, whether it is revenue expenditure line or whether it is through the capital expenditure part. But longer term, this problem needs to be fixed. I don't think we can have a situation in India is constantly running around 10% fiscal deficit. I mean, you have a massive crowding out effect. Obviously, that's to higher interest rates compared to whatever should be the case normally if there was much better fiscal management. So it has its own negative implications as far as growth is concerned, more in the medium to long term. In the short term, okay, you can spend more money, you get some growth, but it's a very high price to pay for it eventually because the economy has to live through very high interest rates in that case.
Yeah. Yeah. So would the market be disappointed with if the FM doesn't project anything lower than 6% for next year?
The market is a little bit of an anomaly in the sense, it always wants growth, right? So fiscal consolidation actually is anti-growth.
Right.
Whereas if you, increase the fiscal deficit, market may be for all, happier, in terms of growth. But obviously it has negative ramifications for the amount of government borrowing which has to be done and the bond yields and so on and so forth. So we'll have to see, what is the implications of the trade-off between higher fiscal deficit and growth, or lower fiscal deficit, lower interest rates. And I don't know which one is the more exciting part as far as the market is concerned. But in the short term, at least, market always prefers growth. That's what I have seen. And anyway, you can already hear the narrative about rural recovery and all that stuff. We talked about based on the fact that the government will do incremental spending in the run-up to the elections and so on and so forth. So this form of fiscal consolidation, which is good for probably, the macroeconomy in the medium to long term, that could be slightly disappointing for the market.
Sure. Just going back to global markets, because those are the big risks that is, from a market perspective, where do you see rates peaking and how long do you think it will stay there?
It looks like, most of the global economies rate more or less near peak interest rates, I would say. Maybe another 50 basis point as far as the US is concerned. Around 5% it looks like you could possibly see the peak as far as US Fed rates are concerned. Most of the other countries, I think, are already there as far as peak interest rates are concerned, barring the ECB, I would say. The bigger issue is, how long do interest rates stay where they are?
Yeah.
And that's where the real battle is going to be between the central banks and the market next year. The market will be probably hoping for, a reasonably quick pivot from the central banks. And as of now, if you look at the US Fed fund rate, the market seems to be assuming that you would see 2 rate cuts by the end of calendar 2023. We'll have to wait and see whether, you'll see any pivot in 2023 to start with and how much. So as of now, the challenge is the market seems to be more focused on headline inflation, which will obviously come up very sharply going forward, as long as you don't see any negative surprises from food or fuel. Both you really can't really forecast, but at least based on high base effects, you will start seeing headline inflation starting to come off really strongly. And that is what the market is focused on. But if you look at the underlying data, the problem seems to be core inflation is still very, very sticky. It is not showing any signs of coming off. And if that stays high, and that's what probably the central banks will focus on, because that is a measure of more embedded or influenced valuation, and that's what the central bank would like to break. Which means central banks may probably sustain the peak rates, whatever that may be. Let's say 5% in the case of US federal fund rate. That could probably stay at a higher level for a longish period of time, and that may possibly disappoint the market. So, I think the second point is a bigger issue going forward, not just the level of peak interest rate, which I think we are more or less getting there, but how long do peak interest rate stay? Whether you see 9-10 months of peak interest rates and then a decline, or you see an extended period of very high interest rate, which could definitely disappoint the market.
Sure. And where do you see Indian interest rates? Do you think we also stop with another 50 basis point hike, and this yield differential, which already, between Fed and Indian interest rates, is that going to stay already at a decadal low? Do you think that differential will continue to be the new equilibrium?
Well, I think as far as India is concerned, looks like we're already there, 6.25 or possibly 6.5, and I think we're broadly there as far as peak rates are concerned. Again, keep in mind the fact that inflation can be fairly volatile in India, depending on, again, what happens to food prices. Thankfully, you start we have seen a big cooling off in vegetable prices, which should definitely
Right.
result in headline inflation starting to come off. But having said that, even in India, core inflation is still going to be on the higher side. If you look at our own forecast for FY24, we're looking at headline inflation at about 5.3% average for FY24. But core inflation is more closer to 5.7, which is closer to the upper end of, as far as the RBI is concerned. So again, the RBI may not be in a big hurry to reduce rates. I think it will probably stop at 6.25 or 6.5. But I suspect it will also just keep rates on a longish pause for some time.
So, Sanjeev, back to the same thing, the yield differential between Fed and Indian benchmark rates is at the lowest ebb.
That's
So,
correct.
what does this mean for the rupee? I mean, do you see big risks on the external account?
We're already seeing that. No, so as of now, you have two challenges as far as the rupee is concerned. One is, of course, from a current account perspective, because of high oil prices and high energy prices, I should say, because even coal prices gone up significantly. You have seen a big explosion as far as the current account deficit is concerned in FY23 compared to the last 5 years. This year, I suppose current account deficit could be in the range of low 3%. That is negative, of course, compared to a surplus in FY21, maximum of negative 2% that we saw in the last 5 years. So first problem is the current account deficit has gone up, and the financing of that is becoming slightly more difficult because you have seen fairly large amount of outflows from FIs. You have not seen any real step up in FDI inflows in the current year. And that's the reason why you have seen a big decline in the reserves of the RBI also, apart from all the mark-to-market issues and etc. So that is the first problem. On the trade/current account part, you are starting to see some amount of negative outflows really. POP has become negative. And second is, if the yield differential is so much against India, obviously not going to see any inflows, right? So till that time corrects, and hopefully that is going to be a correction more led by the fact that, hopefully, inflation starts coming off in both India and the US, and the yield differential in real terms, starts to balance out a little bit. As of now, if you look at the real yield differential between India and the US, it's actually on the lower side, which is obviously resulting in a lot of pressure on the currency, because obviously people are going to look at, any part of the world which offers much higher yields in either nominal terms or in real terms.
Right. So, what is your sense of crude? Because there again, I mean, this year has been actually surprising. I mean, everybody at the start of the year was probably thinking that we are going to be averaging around $100 or at least $90 thereabout. It's been sort of a positive surprise. Going into next year, every now and then you hear these threats from Russia that it will cut production. OPEC, of course, decided something, but it's not really going that way. China, again, I was reading somewhere that the transport fuel in China is not really a big component, which was seen as a threat, that if there is, Chinese economy opens up, then there will be greater demand on crude side, which doesn't seem to be playing out. Overall, do you think the average for next year will be lower than this year, or 100 thereabouts?
No, it should be lower, looks like, assuming we don't see any negative development in terms of geopolitics or supply side issue or anything like that. So this year the average will be closer to 100, and when I'm saying the FY23. Next year, as of now, we assume 90, but let's see, where it settles down eventually. It will all depend on supply-demand dynamics. And here the supply matters a lot more. I mean, demand really honestly doesn't change that much as far as oil demand is concerned in the short term. It's a very inelastic product in that sense. So even if China opens up, I don't see no big upsurge in demand, etc. as far as crude oil is concerned. Real issue is supply. The good thing has been that most Russian oil has been available in the market as far as India is concerned, which means, we have seen some amount of downward pressure on oil prices compared to the expectation that a lot of Russian oil will go out of oil market because of all the sanctions which have been imposed by EU as also the US. Even now, after the recent developments on, in a way, ban on all seaborne oil imports into Europe, it seems like the oil markets are rebalanced. Instead of oil going to Europe, it is coming to China, India, Turkey, from whatever I read. So it looks like, most Russian oil is available, and that is what is resulting in the downward pressure on oil prices. So hopefully that continues. No major disruption in oil supply going
Right.
forward. And that's what India needs, I would think, next year. We don't want any sudden shocks, from oil, which can be negative for growth, for inflation, current account, BOP, everything actually.
So what do you think is the biggest economic risk going into next year?
I just hope we see a reasonably quick rebound. We're hoping for, sustained demand as far as discretionary demand is concerned, and a pickup in basic or staple demand. So far it looks like staple demand is picking up, and that seems to be expected line, because obviously a lot of households which are very badly affected by COVID, or the low-income household which had to in a way cut consumption of even basic products because of job losses or job downtrading, whatever was the case. Thankfully, because reopening of several sectors which got affected by COVID, we are starting to see jobs coming back, income levels starting to recover, and basic consumption starting to come back. But for some strange reason, we are starting to see, big decline in discretionary consumption. So I don't know what happened to certainly middle income and high income households, but has been there change in the psyche or financial condition which have resulted in them starting to slow down consumption. So I have, really no sense on that. And as I explained some of the reasons, but I'm not able to really pinpoint.
But then isn't that a natural outcome? Because in the last 2 years, especially post-pandemic, you saw that is where the big surge was, even before that. So isn't this a natural correction process?
See, you had a big increase in savings actually. If you look at the data for FY21, household financial savings actually went up significantly. So clearly, households, especially the middle and high income households which had the ability to spend, really could not spend, because typically they will spend significantly on services, not so much in good, because they mostly will have most of the good that they would like to consume anyway. Apart from some replacement demand or some incremental demand for appliances, etc. So their incremental spending, which got affected, was really on services part. But now that the services sector started to open, when I say services, really a combination of hospitality, travel, tourism, transportation, etc. They should be spending a lot more aggressively. But for some strange reason, we are starting to see a slowdown of late. In the last 6-7 weeks only, we have started to hear this negative commentary from companies.
Right.
So I'm not very clear what exactly is the reason over here.
Fair enough. And where do you see pockets of opportunity, if at all?
In terms of investment, you're saying?
In terms of in terms of stocks and sectors.
Mostly the banks, I would say, because valuations are quite okay. In fact, they're quite cheap for some of the tier 2, tier 3 banks and NBFCs. And at least for next 2-3 years, doesn't look like credit cost is an issue. Credit cost, as you rightly pointed out earlier, is picking up. So hopefully that sustains. There could be some pressure on NIMs as we go forward, but broadly speaking, given a combination of compounding and book, no negative damage to book from credit costs, etc., and some relating in at least the tier 2, tier 3 bank things, you could see actually meaningful return. Even if you look at the tier 1 banks and BFCs, even if you don't see any relating over there, just because of compounding, you could make some money over there. The rest of the sectors, especially the consumption sectors, which have seen a big relating in multiples, my concern over there is, even though growth may be fine, whatever there's, hopefully we go back to, low double-digit, mid-teens kind of growth for most of these companies. You could possibly see some derating in the multiples for the reasons highlighted earlier, which means some of the increase in earning numbers gets offset by lower multiples. So your stock market returns will trail earning growth in that case for some of the consumption names. So I think the volatility remains mostly the financial space only at this point in time.
IT, you would be bearish?
Keep underweight for the time being, till the time you see some clarity on what is really emerging on the demand side. So as of now, we are starting to see some slowdown on the discretionary part. We'll see, how much slowdown is there in the US, because the US is also, the macroeconomic indicators are quite mixed as of now. On the one side, you're still seeing fairly strong growth in the economy in terms of labor market, consumption demand, and so on and so forth. We're starting to see some slowdown in the housing market, but clearly it looks like the US Fed will have to keep rates on the higher side for a longish period of time. And the whole idea is that you actually try and kill demand to some extent and weaken the bargaining power of the labor force over there. I mean, we are not seeing any signs of that so far.
Right.
Means, you could possibly see a far bigger slowdown in the market, in the economy than what the market is prepared for currently. That can't be good for demand for at least a discretionary part of IT services. Multiples are okayish, I would say, still slightly higher compared to pre-COVID levels, but at least, looking more palatable compared to where they were, say, let's say in February, March of this year.
Fair enough. And sorry, I wanted to ask you one question on financials. There is some kind of iffiness about the SME book in banks. Do you think that could be a risk at all?
Doesn't look like, I would say, Mahalakshmi at this point in time. Because see, if anything had to happen, it would have happened in the last 2 years, when you had very, very bad conditions for the MSMEs, right? You had a sustained period of very low economic activity for many of the sectors, which is where MSME sectors is involved. So as of now, given the recovery in the economy, hopefully, this company should be okay. The risk is, more coming from if there is this sudden deceleration that we are seeing in spending, etc. How does it impact, cash flows? Do companies, start expending, the receivables for some of their own suppliers and contractors, etc., which starts, stretching the cash flows and balance sheets of some of the weaker or actually the smaller MSMEs. So that's where some challenge could come from. But from a macroeconomic standpoint, I don't see any reason why you should suddenly see a big increase in NPLs as far as the MSME sector is concerned.
Fair enough. One last question on new tech. What's your take? Now, a lot of price destruction has already happened. Now, companies are also obviously talking about, getting to break even and all of that. But doesn't mean that, it's changed anything dramatically in terms of business fundamentals. What's your take?
Look at, every segment on a more bottom-up basis because the competitive environment is very different.
Yeah.
For example, food delivery seems to be in a better position, I would say, given the fact that you have more or less a duopoly now. The chances of, managing cost and hopefully, getting to profitability seems to be a lot better compared to, let's say, the fintech space, for example, where you still have way too many players. And I don't know what is the competitive reason for a fintech lender compared to, let's say, any normal, bank or NBFC lender. Because clearly they don't have any really competitive advantage in terms of cost of funding, right?
Correct.
As far as lending space is concerned. So you have to look at more on a bottom-up basis. And obviously the problem is, if you have higher cost of capital, and lower ability of the market, to digest risk, these are the factors which would suffer the most because the more back end of the cash flows, if you do a simple DCF, you raise your back, the valuations just collapse actually. So that's what we are seeing in most of these internet companies with negative cash flows in the first several years, and then hopefully some recovery in cash flows, etc. More back end the cash flows, higher back. It's a simple DCF valuation will come out dramatically. So that's what we are seeing currently.
So are you convinced about the kind of valuation model you need to use for a Zomato and Nykaa? Because whichever way you look at it, whether it is earnings or DCF, I mean, even after this price erosion, this kind of looks slightly out of whack.
It's very tough because ultimately you're taking a big call in the future. In the sense at some point in time, cash flow will improve. And that ultimately boils down to your call in the management. That's what ultimately, investment in some of the new tech companies all about, whether the companies, and when I say companies, more the management, can continue to negotiate all the challenges which will keep coming up. You obviously, you also will see, bouts of competitive intensity. As of now, it's starting to come off, but that could also, increase going forward. Who knows? Some of the more traditional companies could also want to compete in some of these segments.
Correct.
So the ability to manage and negotiate a very complex environment is what the market is eventually paying for when it comes to these companies. And hopefully, when the dust settles down, you are back the right company. So, and in a way, it's a VC style model investing, right? You back 10 companies, 2 of them become successful, you're okay in that sense.
So you're saying even in the public space, we have to approach these companies as if we were approaching ventures?
Unfortunately, that's what it seems to be now. I'm not too sure whether that's the right approach for a public market investor, but your ability to forecast the future is as good or as bad as mine, right? So ultimately it becomes a call of the management, whether whatever will be the future, the management does have the ability, to deliver irrespective of the future outcome, you know. So that's the call ultimately you're taking over here.
Right. All right, Sanjeev, wonderful talking to you. Have a wonderful new year. Thank you so much.
My pleasure entirely. Thank you. Bye.
Bye-bye.